So I like to start off whenever I give any presentation about what's happening in the economy with this chart. It's the Institute for Supply Management's Purchasing Managers Index, and so it's essentially a sentiment survey. So it shows you what manufacturers are thinking, and so this is over the last 16 months. But it also in many ways allows me to kind of summarize at least what's happened over that time frame as well. So just as a nice refresher, since most of you probably don't follow this survey, numbers over 50 mean that the manufacturing sector is growing. Numbers under 50 mean that the sector is shrinking, or that particular measure is shrinking. And notice that the main index is never under 50 throughout the last 16 months. So that's the good news. The good news is that the manufacturing sector is growing, although not as much as we would like. The other big thing to notice here is that you see at the beginning of last year, so in January, February, March, et cetera, we had quite a bit of conversation about the weather. I felt like a meteorologist. I talked about the weather so much. And if you remember, first quarter GDP declined in the first quarter of last year. A lot of that was weather. It wasn't all weather, but that's a large part of it. But by the time we got to the summer months, manufacturing actually was growing very strongly. And so you saw in the second half of last year very robust growth. And in fact, not only was that number over 50, but in almost all of the second half of last year, it was over 60. So it suggests that manufacturers were very upbeat about both demand and production, and so much so that there was a sense, coming into 2015 that, this might finally be, it's a little bit of a deja vu feeling, this might finally be the year where we get some traction in the economy. So you saw lots of forecasts, including from me, of GDP for 3% for this year and all that kind of fun stuff. But the reality is, and as you see here on this chart, that it didn't quite materialize. And you see that overall manufacturing activity has decelerated throughout much of 2015, really starting in December. And why is that the case? Well, there's a number of headwinds that are hitting the manufacturing sector right now, and so I'll kind of tick them off. The first is the dollar. So anytime I have any conversation with any manufacturer around the country, the dollar comes up, and I'll show you why in a second. The other is just in general sluggishness in the global markets, and so you see, when you look around the world, despite the fact that we've had these challenges, the U.S. actually looks pretty good, and the rest of the world not so much. Number three, crude oil prices, and so keep in mind that manufacturing includes the energy sector, it includes the supply chain for the energy sector, and so crude oil being where it is, although it's better at $60 a barrel than it was at, say, $45 a barrel, it's certainly a lot lower than it used to be, and you're seeing a lot of investment in the energy sector dry up. And so that's having ripple effects throughout the manufacturing sector, particularly in the supply chain. It's good for consumers, but for manufacturers, and particularly in the energy sector, that's a pretty major headwind for them. The other thing that has affected a lot of manufacturers in the first quarter, and hopefully that dissipates over time, is the West Coast ports slowdown. I suspect you heard quite a bit about that in Illinois. And even though that was settled, quote unquote, a couple of months ago, the reality is I continue to hear stories about how West Coast ports are slowing down, either sales going out or supplies coming in. And you're shaking your head, so yes, the West Coast ports issue is still a very real issue. Hopefully that will dissipate with time, but it certainly has become quite a headache for a lot of manufacturers, and it shows up, I think, in a lot of these numbers. And then,
how long we expect that to show up?
Well, I think it will take probably a couple more months, I think, for it to really work its way through. Would you agree with that? Yeah. And so it just shows you the extent to which that a lot of goods come on that West Coast into the U.S. as well as out of the U.S., affecting a lot of things. The other two issues, once again, weather. But weather, unlike last year where it was national in scope, this year it's been more regional. So snows in the Northeast. When Boston can't handle snow, it's a lot of snow. And it shows up sometimes in the retail sales numbers or in housing starts, and you see that pretty real effect there. The Midwest also had, a typical winter, I guess, since I'm from Illinois, a typical winter. And in the West Coast, you hear quite a bit of conversation about drought. And so you're still having regional effects from weather, but not quite to the extent you had last year. And then the last thing to point out is the consumer. So the consumers, despite the fact that we have lower gasoline prices, despite the fact that the consumer you would think would feel a little more giddy, I guess, about where they are, they still continue to be very cautious. And you've seen that even in the last couple of days. We got retail sales numbers on Wednesday, and they were unchanged. They were flat. So you're still continuing to see relative weakness on the consumer side. So that's an awful lot of headwinds, I guess, really, and that helps to explain why you've seen some relative weak numbers. Now, the next couple charts, actually, we got new numbers this morning. These have not reflected that because I've been driving, so I haven't actually. If I was driving and changing PowerPoint slides, you'd worry about me. So we do have April numbers, and you saw that the manufacturing data for production in April was unchanged, so it was flat. And so what that essentially means is that, for 5 straight months, we've had relative softness overall in terms of output. Again, very consistent with the last chart that I showed you. The overall number for total industrial production has declined for 5 straight months, but total industrial production includes manufacturing, mining, which, as I just said, is struggling right now, as well as utilities. So those other two are really what's pulling that number down in April. And you've also seen kind of the year-over-year pace decelerate. So, we had roughly 4.5% growth on an annualized basis at the end of last year. Again, very robust growth, lots of activity happening in the manufacturing sector. But you've seen that decelerate pretty sharply from November to today. Now, basically on a year-over-year basis, manufacturing has increased 2.4%. So you've seen that growth rate decelerate, again, largely on the headwinds that I mentioned. That's still not a bad number, but we would like to see it a little stronger. So here's the GDP outlook, essentially. So again, you see that huge decline at the beginning of last year. 2014 actually was not as bad as that kind of headline 2.4 number sounds. The reality is, in the middle of the year, we had 4.6 and 5% growth. So that averages out to roughly 4.8% growth in the middle of the year. And this number actually was not as bad as advertised. I mean, the reality is that if you were to just look at consumer spending and business spending, so that's, for those of you who like economics, that's the C and the I part of the GDP equation. If you were just to look at those two parts of GDP, we would have had 3.6% growth in the fourth quarter. What really brought that number down was net exports and government. So, government is kind of a perennial drag on GDP. So the bigger issue, really not just in the fourth quarter, but also in this number here, was that net exports. Remember that major headwind that I started off with. The dollar, weakness abroad, exports have not certainly kept up with import growth. And so as a result, in this number here in the first quarter, net exports subtracted out 1.25 percentage points from GDP. So it shows you the tremendous amount of headwinds that we're seeing from the international markets right now. The other challenge, of course, is that that number is 0.2 for the first quarter will likely get revised down into negative territory, primarily because since this number was released, we've gotten worse numbers on the trade deficit, as well as some other numbers have come in pretty soft. And so will probably fall a little bit into the negative camp. Beyond exports, you also had really consumer spending on goods was flat for the most part, so that's not obviously a good thing. And on the business investment side, you had actually declines in spending for structures and stuff. The good news is, and you see that with my red bars after that, after a bad quarter, we often have a little bit of a rebound, and so it's not unheard of to see that kind of bounce back up to in the 3 range. And I think, again, if you get consumers to come back spending and businesses to come back spending, that's certainly in the doable range. The challenge is, I think that we have started already to see some soft numbers for April. So this number might get revised lower a little bit, perhaps to a little. I saw in the Wall Street Journal today, the consensus estimate for the first quarter is 2.8. So you're starting to see, as some weaker data have come in, I might end up having to revise this number. But in general, and we're in the 3, maybe high 2s, lower 3 range for the rest of the year. A lot of that hinges on a rebound in consumer and business spending, and hopefully that happens. Part of why I continue to cling to these numbers is that, in general, even despite some of the current challenges, manufacturers' outlooks continue to be relatively good. I've been doing a lot of tours around the country lately, and when you talk to manufacturers, oftentimes, despite all these headwinds, in general, they're relatively upbeat about sales over the next 6 months and about production over the next 6 months. So this survey is one we do quarterly, and in fact, just today, for those members of the NAM, they got an email from me saying, please fill out the next survey, which will come out in June. And you see that 88.5% of our members were positive in March. I partly expect that number to come down a little bit when we release the next one in June, but still generally upbeat and, or cautiously optimistic, I guess, if you want to say that, in terms of the outlook. I think the diminishment really will happen primarily because of the headwinds that I mentioned. So almost every quarter I ask, what are the top challenges? I don't think any of you are shocked by what these are, considering we're a trade association. But the number one issue really for the last couple of years has been healthcare costs, particularly for small and medium-sized members, very large increases in premiums, and that's really what's driving this. The other big issue on the Obamacare front, I think, moving forward is the so-called Cadillac tax. And the fact that in 2018, if your total benefits, not just health care, but your total benefits exceed a certain level, there will be an excise tax of 40% attached to that. And you're going to see a lot of companies pushing benefits below that threshold so that they don't have to pay the tax. That's certainly kind of an up-and-coming issue that actually unites manufacturers with unions, actually, because they aren't overly happy about that. But that's certainly the top issue, has been for the last for a couple of years. That's followed very closely by taxes and regulations. So that's the need for corporate tax reform or comprehensive tax reform, as well as doing something on the regulatory front, particularly against EPA, the National Labor Relations Board, OSHA, the whole gamut of regulations coming at us. Then this ranks number 3, but the reality, and it says 56.2. But the reality is almost every manufacturer I talk to is having challenges with attracting and retaining a quality workforce. It's never got the percentage level that it has in this survey that it does in a lot of other surveys, but it's still a very major issue for our members. And then you have the dollar. I suspect that percentage will go up in the next survey that comes out in June. Okay, so I've already mentioned to you the international environment, so we'll just go through a couple slides just to kind of illustrate that. So first, this slide, this is the good news part of the international story, so be ready for good news here. So the last year we hit an all-time high in terms of manufactured goods exports, $1.4 trillion. It was the 5th year in a row where we hit an all-time high, so that's the good news. The bad news is that the slope of that line continues to slow a little bit. So last year it was 1.9% growth was the increase in manufactured goods exports. The year before that it was 2.6%. The year before that it was 5 point something. Look for that number to be less than 1, probably, between being flat and 1% this year. Again, largely on the headwinds that I mentioned earlier with the dollar and the slowing global economy. So far in the first quarter, they're actually down. So in order for us to even be flat, we would have to rebound a little bit in the remaining 3 quarters. So why is that the case? So if you get my Monday economic report, you also get my global report, which came out yesterday. Even though I'm on the road, it still came out. And so this is kind of the dashboard that I look at when I'm doing that particular thing. So this, much like the first chart, shows you manufacturing activity. So it's a PMI number. Numbers over 50 are expansionary, and they're blue. Numbers under 50 are contractionary, and they're red. And this is the top 10 markets for U.S. manufactured goods in order. So Canada, Mexico, China, Japan, all the way across the list. And the bad news here is that 6 of the top 10 are currently contracting. One of them is just barely contracting. You can give Japan the benefit of the doubt there and say that they are essentially stagnant. They are almost 50. But nonetheless, this is a deterioration we've seen in the international markets over the last couple months. The March data, the March graph, just like this, we had 5, so it's up from 5 to 6. And in the February data, it was 2. So we've clearly seen a deterioration in manufacturing activity internationally. So I'll do a quick trip around the world and show you kind of some highlights here. First is Canada. Canada is our largest trading partner, and they've contracted for 3 straight months, almost entirely because of oil. Much like Texas, Canada is a major energy player right now, And so when you go to the Alberta and British Columbia regions, clearly you're seeing sentiment down because of lower crude oil prices. When you get outside of Alberta and British Columbia, the rest of Canada is growing modestly. So it shows you that this headline number really is being pushed lower by energy prices. In general, our exports to Canada have been relatively flat over the last couple of years, and so this is obviously something that is a challenge. Mexico is growing modestly, not as fast as we would like for it to be growing, but they're certainly doing a lot of things moving in the right direction. China has contracted for several months in a row now, and the issue with China is that the Chinese economy is slowing, and so they grew 7% in the most recent quarter. That's a number we would love to have, 7%, so just to put that in perspective. That assumes that you believe the number anyway, but we're going to take it at face value and assume that it's a real number. They clearly are slowing from where they were, just a few months ago. So I think the last global report I had actually had the graph of what GDP growth rates have been over the last few years, and you clearly have seen that fall over time. And so as China is grappling with being a maturing economy and it's slowing, you're seeing that really play itself out really throughout much of the rest of Asia. Not so much Japan because it marches to its own drummer. But you're definitely seeing the rest of Asia, South Korea and Hong Kong over there. As China struggles, so does the rest of Asia. And you're seeing that kind of play itself out in terms of overall manufacturing activity. One other contraction, and then we'll get to Europe. Brazil is a mess, so we'll just leave it at that. South America continues to be weak. Brazil in particular, but also a lot of other parts of Brazil as well. This number continues to get lower and lower, which is not a good sign. In Europe, where you actually see some expanding economies, you have to put that in perspective a little bit. So yes, they're better than they were, and that's a good thing. So they're moving in the right direction. I have to laugh because yesterday in the Wall Street Journal, there was the headline was how wonderful European GDP was, how it was the best in 2 years. And I had to kind of do a double take because I had already written the global report. I already knew what that number was. I knew it was 0.4%. And I'm like, did I miss something? Yeah. So you have to keep it in perspective. Yes, 0.4 is better than 0.3 and 0.2, which were the quarters right before that. But it's still not growing as robustly as we would like it to be growing. And on a year-over-year basis, it's growing roughly 1%. So there still are a number of challenges there. The good news is it's getting better, and that's what these numbers are showing, is that the manufacturing activity is getting a little better. But the unemployment rate is still 11.3%. Income growth is still relatively sluggish. And the European Central Bank is spending €1 trillion over the next 18 months to help prop up the European economy as a result of that. And so, again, some good news there, maybe not as good as the headlines in the paper, but certainly I saw some movement in the right direction for Europe. Now, I spent a long time on this because this is our market. When they're doing well, hopefully they're buying more of our products, and when they're struggling, they clearly aren't, and that's why that has become something of a headwind lately. Now, I also mentioned the dollar. My wire's coming out there. I mentioned the dollar. Now, this is actually a week old because the Fed releases this, so on Monday we'll get this week's data. So there's still a week lag here. This shows you what's happened to the dollar over the last, 16 months. And you see that since June, the dollar has appreciated pretty rapidly. And in fact, at one point, it was 22% higher than it was at the end of June. We've seen the dollar pull back a little bit since then. And so even after this graph here, we would see it come down even more if I were to show you a little bit of this week. And so what's moving that? Well, even, I guess, first off to say this, even with the weakening that we've seen in the dollar in the last month or so, the dollar's still roughly 16% more than it was in June. So it's still a good time to go to Europe if you're going to travel. Not so good if you're a manufacturer, which is why you continue to hear the challenge that the dollar presents for them. So why has it appreciated, and then why has it depreciated a little bit since then? Well, number one, the dollar has strengthened for all of the right reasons. A lot of investment still flowing into the U.S. The U.S., even with some of the headwinds I mentioned at the beginning, still looks a lot better than a lot of our foreign partners. So you still have the overall markets reacting to better economic news in general. At least that was the thinking up until about a month ago. And you also, because of monetary policy shifts, because the Fed's going to start raising rates later this year, You have to contrast that with what's happening around the rest of the world, where the European Central Bank is spending €1 trillion on quantitative easing, where Asia is doing its own stimulative measures. And so you have that dichotomy between what's happening abroad and what's happening here. And that's really what's pushed the dollar a little higher. What's weakened it a little bit has been a couple things. Primarily, it's because Europe is doing a little better than people thought. Go back to my conversation in the last slide. And the US is doing a little worse than people thought. You know, the slide where I just showed you, 0.2% growth in the first quarter, and that's going to go down, right? So because of that, that really shifts everyone's thinking in terms of when the Fed does what it does. So the Fed was pretty much on target with raising rates in June. That now looks more likely to be raising rates in September at the soonest. And there are a lot of market players who think it shouldn't be September, it should be perhaps next year. I'm not in that camp. I think it should be September. I thought it should have been June. So whichever way you look at it, that's what's moving this market here. Eventually, the Fed will raise rates. And in general, the dollar is going to continue to stay strong, but that's what's moving the dollar here in the last month is this perception, not about the relative strength or weakness of the US relative to Europe and other countries, and how that affects what the Fed does. Does that make sense? So there's your little monetary policy lesson for the day. So now we'll get to labor markets. And in general, we've seen relative strength in labor markets. And in fact, the labor markets have been moving in the right direction. So I'm going to put a glass half full version of the story here. So you clearly see some weakness in the last 3 months there. Certainly those are disappointing numbers. I'm looking just at the red bars here. So that's the 3, the 0, and the 1. Those are thousands. But over the last 16 months, manufacturers have actually hired, on average, 14,500 workers per month. So that's actually a relatively strong number. Clearly, there are some months, 45 here, where we've been a little stronger. Some months, 0, where it's been obviously a lot weaker. But in general, that has been a relatively strong pace. We currently have 12.32 million workers in the US in the manufacturing sector, and my forecast is we'll have 12.45 million by the end of the year. And that pretty much assumes that we'll return kind of to that 14,000 pace for the remainder of the year. Hopefully we'll see better numbers when we get to May and to June, but for right now, in order to make that, we're going to have to bounce up a little bit. We already saw a little bit of a rebound on the blue bars. So you saw the weak number in March, but the April numbers for non-farm payrolls was actually up. And so you've actually had now for 13 of the past 14 months non-farm payroll growth of at least 200,000. So that's a pretty strong number. The average over the last 16 months is roughly 250,000. So you've seen that number continuing to move in the right direction, which is obviously a nice positive. And hopefully we'll see a similar rebound for the manufacturing sector. In terms of the unemployment rate, it's currently 5. This is the orange line here. It's currently 5.4%. Look for that to get to 5.1, 5.2% by the end of the year. And now, having said that, I want to give you a little asterisk, which I'm sure you're all thinking, which is that the unemployment rate today means probably a lot less than it did, say, 5 years ago or 10 years ago, or certainly back when I was studying economics in the late 80s, early 90s. At one time, 5.1 would have been considered full employment. That's probably not the case today, particularly when you look at the fact that we have still a lot of problems with part-time employment, with underemployment, with the participation rate being very low. The real unemployment, so-called real unemployment rate is actually double 5.4. It's 10.8%. And while that's also moved in the right direction, at one time it was 17. It still is a large number. So you still have a lot of what Janet Yellen calls slack in the economy, so in the labor markets. And so, yes, this is a good sign. It's a movement in the right direction, but it's also, you have to keep it in perspective a little bit. That headline number, I think, means a lot less than it used to. So looking at the labor market over the last 16 months, in general, manufacturers have added roughly 860,000 workers back since the recession. And over the last 16 months, these are the sectors that they have come in. So primarily, you see lots of durable goods, transportation equipment, so that's motor vehicles, it's aircraft, Boeing up in Chicago, Fabricated metal products, you can continue going on down the list. Two durable goods here to note, plastics and rubber products and chemicals. Chemicals were pretty solidly in the negative territory before shale, so you can insert the word shale for why these two sectors are doing so well. Lots of investment continues to flow into the chemical sector in the U.S., and so that number is continuing to kind of move up the rankings ordinally. But in general, these are the sectors that are growing. If you don't see a major sector up there, it's because it's negative, and there's no reason to depress anybody. So in terms of states, unfortunately, Illinois is not on this list. I'm sure you may or may not be shocked by that, but you definitely will see lots of your neighbors on this list. You see up there Michigan, Indiana, Ohio, Wisconsin. Those are 4 of the top 5 states for manufacturing growth in the just in the last, again, 16 months or 15 months, because this is through March. You also see a lot of presence from the southeast on this list as well. Lots of investment flowing into the southeastern part of the U.S. I say this not to depress you, but that is the top 20 list for the most part. Illinois is not at the bottom, so that's the good news. I won't tell you, I guess it's New York and New Jersey which are at the bottom. So now we get to the overall employment picture, just to kind of put that in perspective a little bit. Last year, overall, the non-farm sector got back to its pre-recessionary levels of employment, kind of in the summer time frame. For manufacturing, though, we still are roughly a little more than 10% below where we were at the beginning of the recession. And so this is where you can insert the words lean, doing more with less, lots of efficiency gains. And so that's essentially where we are for the manufacturing sector. Just to kind of put it in perspective, we lost 2.3 million workers in the recession. And we've gotten back, as I mentioned, about 860. I'm going to skip those couple because I said them already. So let's get straight to consumer confidence. This chart also does not include the consumer confidence number that came out this morning. But in general, we have a bit of a nuanced picture when it comes to consumer confidence. Consumers and businesses are generally more upbeat than they were last year or the year before that. And you see certainly some upward movement overall in terms of sentiment surveys. But we also kind of surprisingly have seen a little bit of a weakening in some sentiment surveys, including the one that came out this morning, a bit shockingly in some ways. Keep in mind, I kind of hinted about this at the beginning, but gas prices are dramatically lower than they were, last summer or last spring. And going into the holiday season, there was this expectation amongst a lot of retailers in particular, that people were going to go out and spend that extra money, that people would feel richer in their pocketbooks. For a while, gasoline got below $2 a gallon. At least I think it did in Illinois. It certainly did in Virginia. But now it's up from where it was, but still it's less than what it used to be. And there was a belief that people would go out and spend that money. We haven't seen that. And in fact, what we have seen is the savings rate has gone up. And you've seen a little bit of consumer confidence dipping a little bit in the early months. Now, part of that could be simply a reflection of the fact that we've seen some weaker data points as well. And part of it also could be a little bit of an income disparity conversation. Households making more than $75,000 are more upbeat than those making less than 75, and so you sometimes see a give and take between those two halves of the consumer conversation. But in general, so I guess you have a little bit of a nuanced picture on the consumer and the retail front, and we haven't quite seen the retail sales bounce back the way we would like. Motor vehicle sales are kind of hovering around the 17 million mark, going up and down a little bit. We saw some weakness on the vehicle sales December, January, and February, a little bit of a rebound in the month of March, and so March and April. And so hopefully we'll continue to see some strength there. On the housing side, we've seen overall housing starts be relatively flat over the last year and a half. A number of factors really played into that. In 2013, it was mortgage rates. That's less of a factor today because mortgage rates actually are lower than they were for a while. The bigger issue in 2014 and kind of coming into 2015 is it's just much more difficult to get a mortgage today. The student loan crisis, if you want to call it that, is certainly affecting first-time home buyers. Certainly there are lots of financial challenges. There also are some challenges with rising costs in some areas. Supplies continue to be low. And so, the good news is we were starting to see a little bit of a stabilization towards the end of 2014 in the market. I would completely ignore the decline that we had in both February and March. That was all about the Northeast and all about snow. It's kind of hard to do housing starts in Boston when you're several feet under snow. So in general, we're going to be rebounding back to where we were before, hopefully in the 1.1 million housing starts range in the coming months. So that's, I think, the good news. And just continuing to edge a little bit on past that. The thing to watch on the housing side is once mortgage rates do start coming up again later this year or certainly into next year, how does that affect overall demand? Fortunately, rates are still historically low, and so hopefully that will have a little bit less of an effect. So that was the residential side. On the non-residential side, this is for manufacturing. These are really, really strong numbers. So before I was in Peoria, I was in Lexington, Kentucky 2 days ago. And I was speaking with one of our member companies there that does a lot of construction. Very strong outlook on the overall construction side. And it doesn't show it here, but one of the areas where there was weakness in the GDP numbers in the first quarter was on that energy conversation. The whole energy as well as the supply chain was, as investment has dried up, you've seen some declines in overall investment. But it's not showing up, at least not yet, in the overall construction numbers. This chart in particular gives me lots of encouragement because it suggests that the increased outlook, that cautious, optimistic outlook that we manufacturers have, is leading to additional spending on construction, just like it should hopefully produce some additional hiring. So we have 2 more slides, primarily just to kind of provoke the conversation about the Fed. So this one does not include the numbers that came out yesterday, so that we do have April data for the producer price index. And it was also negative. So you've seen in general energy prices, as energy prices are much lower than they were last year, because these are year-over-year rates. You've seen some deflationary tendencies in the overall market in terms of 4 consecutive months where the year-over-year rate for price increases was negative, but that's all about energy primarily. When you strip out food and energy, you've also seen a deceleration overall in pricing pressures, but not to the extent that they're negative or anything. So it's not like we're having deflation in the larger economy. I would expect this number to kind of drift a little higher in the coming months, but the overarching theme here is pricing pressures really are relatively non-existent for right now. It doesn't mean that they won't happen coming down the line, but for right now, inflation is not really an issue. And what this does is it frees the Fed up to be able to continue to be stimulative if it chooses to do so. Although at some point they're going to start raising rates, and that is really where we get to this chart. So as you know, the Fed stopped doing quantitative easing last October, and so now the other leg to fall in terms of starting to normalize rates is it needs to start raising short-term rates. And this is the rate that they would raise. This is the Fed funds rate. So this is the rate that the Fed charges banks when they borrow from the Fed. And it's been effectively zero since the financial crisis, since October 2008. And so essentially the Fed has kept its foot on the accelerator as far down as it will go for 7 years. And so it's time for them to start gradually lifting it up a little bit. And as I mentioned earlier, the conventional wisdom was that the Fed was very much on target to start raising this rate in June. They had all but signaled that they were going to raise it in June. But then we got some bad data in, and now the conventional wisdom is that has shifted to September. Either way you look at it, more than likely the Fed will start raising rates. But don't overinterpret that. The Fed will be raising rates 25 basis points, which is 0.25%. And they might raise it another time by 0.25% later this year or beginning of next year. But it's going to be a very gradual process. And as this chart shows you, we still are quite historically low in terms of overall interest rates. So I think when the market sometimes overinterprets what this means in terms of tightening, it's not really tightening so much as it's less tight, maybe perhaps. So anyway, that's it. So what questions do you have, either about the economy, about policy, I guess, since we are the NAM, so we do deal with policy issues, or about something I didn't cover?
I'm interested in a couple of the issues coming out of EPA. Your thoughts on the Clean Air Act, the 111D regulations, and the ground level ozone, and what they're going to do to the manufacturing sector?
Well, as you know, we've been pushing pretty aggressively back at EPA. And often case, we're trying to make regulations, bad regulations, less bad. And so that's essentially what we're trying to do through the comment process, working with the IMA and a lot of our member companies. And so that's essentially where we are on many of those issues, including ozone, including greenhouse gas, and a lot of the other ones. At the end of the day, though, they're going to promulgate a rule that we perceive to be a bad rule. And so the big thing that we are trying to do is beef up our legal activity. So we have been suing the EPA as well as other agencies to try to push back against what we feel is a regulatory overreach. One of the environmental cases, I believe, is going to be before the Supreme Court. So we'll have a ruling on that by June. But that's really where we are with the EPA, is again trying to work with them, trying to make sure that we show them how what they're proposing is going to negatively affect manufacturers. Hopefully pushing back and making sure there's an education process there, and in some cases maybe they can tweak it slightly in our favor. But at the end of the day, all of those regulations are going to be harmful for us, especially the ozone rule. I don't know how much you're familiar with the ozone regulation, but that would reduce, if you have ozone emissions in your region, your economic development region, exceeding 65 parts per billion, it pretty much is going to dry up any level of economic development in that region until you can find a way to lower it past that. Almost the entire country would be in non-compliance if that rule would go into effect, and it would be the most costly rule in the history of the U.S. Again, we're trying to educate the public on it, educate governors on it, in particular, to try to push back against EPA. Assuming that does get promulgated, it'll certainly fight its way through the courts. So that's where we are. Similarly, we're trying to do things with against the National Labor Relations Board. In particular, the ambush election rule is something we're pushing back against pretty strongly. That will also work its way into the courts, I suspect.
If you could look into your crystal ball on the energy issues, and I guess as an economist looking forward, we really enjoyed, because of hydraulic fracking, because of other technologies, low gas prices, low energy prices, and we've seen a shift in world markets, but where do you think those energy prices move in the next few years?
Well, about a month or so ago, I was in Texas, which is probably the worst place to give forecasts about energy prices. But I said that at the time, not that I'm bragging, but I said, I thought that energy prices were low, and I thought that they would be up in the $60 to $70 range for a barrel of oil by year end. Well, here it is, a month later, and it's already 60 in that range. I think that's where we're going to settle off this year. I think in many ways the Saudis were successful in terms of, as I mentioned, a lot of new energy investments have they've hit the pause button on it. You've seen the number of rigs fall off. So you're definitely having some supply issues there in terms of dampening some supply in the market, at least new supply. I think all of the existing investments are already still there, and that's why you're still seeing production up from where it was in the past. But that's, I think, clearly playing into that. I think the issue moving forward, and we definitely will see rising prices, I think, moving forward, but not perhaps as much as the energy companies would like. Moving forward, of course, I guess in Illinois, will you start doing shale development? Certainly in southern Illinois, there's lots of shale. Will you start taking advantage of that resource, and is it cost effective? I think those are some questions not just for Illinois, but for some other states that also have shale, pretty large shale deposits. But the other big issue, going back to the EPA conversation, is that keep in mind that natural gas and all of that is a carbon. And so when you're having a real conversation about climate change and about controlling carbon, you're having a conversation that would limit what really has been a strength in the U.S. economy for a while, which is natural gas. And so while much of the conversation now when you talk about carbon is about coal, that will shift very soon to talk a conversation about demonizing natural gas and demonizing any other type of carbon. And so that really, I think, is where we are on the energy space. We need to have a much more comprehensive conversation about what is our energy policy. It should be an all-of-the-above approach. It's kind of naive to assume you can flip the switch, which I think the administration currently does when it comes to coal. You're going to have a much more of a gradual process and have companies make those decisions themselves. But that's essentially where we are. I think, as I said, this is a very pro-regulatory environment and kind of pushing back against some of the successes that we've had recently.
we've been advocating strongly for the reauthorization of the Export-Import Bank. And
Yes.
I'm just interested in your thoughts on the effect, the importance of that, and what the effect of that not being reauthorized would be.
Well, I mean, I think the Export-Import Bank is one of those issues. It's one of a lot of issues right now in Washington that should be no-brainers, but unfortunately, it's getting caught up in politics. And so, the reality is the Export-Import Bank, while it's I think just, when you look at the number of manufacturers that use it, certainly it's a limited pool of the overall population. But for those companies that do use the Export-Import Bank, it's extremely vital in terms of their ability to grow exports, to be able to continue to trade. We did a study last year, I helped write it, that showed growth of export finance abroad versus the U.S. And so in the U.S. it's roughly 30 billion is how much we do in terms of export finance from the Export-Import Bank. In China and Canada and a lot of other countries, France, Germany, their export finance programs are many multiples of what ours are. And if we don't have that export finance there, we often won't make the sale. And our competitors are already going out there saying, you don't know whether the Export-Import Bank is going to be around in a couple months. Maybe you should start doing business with us. And so you're already starting to see that have a little bit of a competitive challenge. It was happening last fall, right before it was punted to this year, and it's happening again. So we need to make sure that we educate policymakers that it's not just the big companies that are using the export-import finance, it's also a lot of smaller members, and there are also a lot of folks in the supply chain of those bigger companies that will be negatively affected if it's not renewed. So the challenge there politically is that you have a lot of conservatives who ideologically oppose the Export-Import Bank. And in particular, you have some very key members of the House that oppose it. And getting it to the floor will be difficult, although Speaker of the House Boehner has said that he supports putting it on the floor, which so that's obviously an encouraging sign. And we feel that once it does reach the floor, it will definitely pass, probably with some reforms, but it should pass. But again, the hurdle there is that you have some ideological opposition to it.
In your opinion, what's it going to take to get Illinois back up into that top 10 of manufacturing? Is it work comp, is it taxes, is it labor pool, all of the above?
Well, Illinois has to deal, as you saw in the recent court case, as well as with the downgrade, has to deal with its long-term structural challenge, the pension issue. And I think that until that happens, you're going to continue to have that hurdle really to get over. Beyond that, I think the big challenge is that you need to be a pro-business state. Other states that I threw up there a second ago, they're all I can tell you because I'm in D.C., so I see it from a national perspective. They love Illinois, right? Because they're out there saying, you should move your facility from Illinois to my state, just right across the border, and this is why. And so you need to make sure that you can clean up your house in terms of the tax and regulatory environment, because otherwise they're already out there saying, move across the border. And in some cases where that's possible, it happens. And so I guess first and foremost, you have to deal with the structural challenge, and then number two, and that's the hurdle, is how you do that and still keep it business friendly, is you have to do something about the tax and regulatory environment, because that's clearly what Wisconsin, Indiana, Wisconsin, all those other states are doing right now already.
I'm aware of, there's a skills gap nationwide.
Yeah.
Filling the manufacturing roles, and I'm pretty aware of what's going on in the state, what the IMA is doing to help lessen that. But I'm not so in tune, and maybe it's not your forte, maybe you don't know. But what's NAM doing to help lessen that?
Well, we actually have been out there pretty aggressively on this issue for a long time. And part of the NAM is the Manufacturing Institute, which is kind of a quasi-independent entity within the NAM, although that will probably move in-house soon, but right now they're quasi-independent. And this has been their issue, is the workforce development for a long time. The challenge is that when you go out and talk to manufacturers, there isn't a next generation of welders, mechanics, engineers, whatever, to kind of replace the baby boomers who are expected to leave the market very soon. And so, a large part of that is changing perceptions. You have a lot of young folks, as well as their parents, who have perceptions about manufacturing, perhaps about blue-collar work. And you need to change those perceptions to show folks that that's not really what manufacturing is today, and that's a large part of why we have Manufacturing Day in October, and a large part of why there's almost like a Got Milk kind of campaign for manufacturing, just to kind of show folks that it's a little different. The other part of it is being very proactive with manufacturers working with educational institutions, like the Danville Community College or any 2 or 4 year institution, as well as high schools, and trying to convince them to offer programs that are going to be useful in terms of being ready to work for those particular facilities. And that's not a one-size-fits-all kind of approach. It needs to be tailored to each specific manufacturer. The other things that we're doing, trying to encourage more women to enter manufacturing. We actually have not seen a lot of growth in women in manufacturing since the recession, and so trying to convince more women to go into manufacturing, I think, is certainly something that is something we're trying to encourage. And we do that through the STEP Awards, so again, trying to kind of highlight women that are in manufacturing. And then the other part of it is to encourage more veterans to go into manufacturing. And so we've been pretty aggressive in trying to get many of our members to hire more veterans that, again, some of those veterans are coming out with skills which could be easily reapplied into the manufacturing sector. So that's kind of a large plate there. And on the federal side, we've supported legislation that hopes to streamline workforce development programs. So quite a bit, actually.
Yeah.